We're counting down to the Fed's interest rate decision at 2 p.m. Eastern Time. Joining us now, Carol Schleif, Chief Strategist with BMO Private Wealth. You got Democrats and Republicans as clients, don't you, Carol?
We do. We have both sides and everybody in the middle.
I bet you don't want to comment. Let's keep it. We'll keep it in the real world here. We were talking about Jay Powell. Do you think he's in a good place? He doesn't have to do anything today. And you also talk about a wait and see with a lot of market participants. But underlying all that, is anything really troubling to you about the stock market or the bond market right now? Or it could turn into something troubling if the uncertainty continues?
Yeah, that's exactly right. We think actually the capital markets, including the currency markets and commodities, are to be applauded for how adeptly they've navigated the last couple of months, because they've adjusted right away to new news like the technological advancement that DeepSeek dropped on a Monday, some of the various labor reports and things that have come out. They've really done a good job at adapting to that, as well as tariff policy that flip-flops from a daily, if not an hourly basis, that's kept it going. But taking it back to the Fed does have some challenges to look at in terms of soft data has turned quite negative. But we know that soft data being a lot of the sentiment data, but we know that a lot of that sentiment data may or may not translate through into economic activity. But watching that economic activity, it puts the Fed in kind of a challenging spot longer term if this uncertainty doesn't clear up. We do think that you could get some policy clarity. We've got an April 2nd deadline on tariffs coming up, and believe it or not, that's 10 days away, basically.
What would be, we look for canaries in the coal mine for something that could be more serious, not just for the stock market, but for the economy as well. Sometimes a stock market can be a harbinger of things to come. But what else would indicate to us that these policies are having an adverse effect on the economy? Would it be credit spreads? Would it be delinquencies? What are you watching for that could be a bigger problem for the stock market?
I think a piece of it is a credit spread. A piece of it is watching the health of those top-end consumers, which have really powered the aggregate numbers, because we talk about how strong the economic numbers have been. 70% of GDP is tied to consumer spending, but it's that top 10%, 10 or 20% that are doing the bulk of it. But it's also watching a lot of what they decide to do will depend on if they feel confident about having their jobs. So a lot of that goes right back to the companies. And the companies that we have here really need some clarity on policy. They don't need no tariffs. They just need to know what they're going to be. They don't need no regulation. They just need to know what it's going to be. And once they have the rules for the game, they can adapt, because they've done really well. Up until now, we've been dealing with tariffs since 2018. We've been dealing with all sorts of logistics and supply chain issues. So our companies have learned how to adapt. But right now, they're in wait and see mode. They've pulled back hiring. They've pulled back advertising. They've pulled back the plant expansion. And if that goes on for a long length of time, you could theoretically see it translate into more layoffs and more trims and a lot more difficulties there, which would translate through then to consumers. So it will be important to watch the economic data that comes through. We saw stronger manufacturing numbers yesterday, but how much of that is trying to front run tariffs? And again, we just need that policy clarity on at least a few points to give business a direction to go in.
You had like 3 sectors that you do think would benefit when things do settle down. What are they?
We've got a variety of places. We still believe in the infrastructure build-out industrial sector. We still think technology and communication services play a key role in what's going on here. Healthcare should benefit too as the implementation of AI gets rolled further out. Lots of industries should really benefit in this. Some of the more traditional defensive industries are a bit overpriced as people have run to safe havens, if you will. But we think there's a lot of optimism. There's a lot of reason to be optimistic about where we started with this economy and where the trade wars, if you will, began, because there was such a solid footing.